clarifying the concept of the naked yield percent and why I suggest the optimum is between 1 and 1.5%. Alberto was watching the introduction to naked puts video, one of the basics of naked puts video. And so he had some questions about the naked yield percentage and why did we say the optimum range is between 1 and 1.5% of this naked yield? Well, first, let's discuss what is a naked put position. All right, we're going to sell to open typically an out-of-the-money put, a put that's below the current stock price on a particular stock. We're going to receive a premium naturally for selling to open this position, typically deposited right in our account when we enter the contract. Your broker will likely require you to put up the full cash secured amount. The obligation of selling the put is that we may be forced to buy shares of stock if the stock's trading below our put strike price at expiration. So your brokerage is going to want to make sure that you have the capital on hand to cover that obligation of potentially buying the stock. Of course, if the stock falls down quickly during the time of the trade, between when you open the trade and expiration, and your put is suddenly in the money, you can always be put the stock early. So your broker wants to make sure that you have the capital on hold or available to fulfill that obligation if you are put early. Okay? If the stock stays above the strike price, the put expires, we keep the premium. We don't have to cover any obligation and the margin is freed up. If the stock falls, we may be obligated to buy shares of stock. And this is important, and this will relate to Alberto's second question, because if my potential outcome of this strategy is that I may end up owning stock, I typically only want to do this strategy on stocks that I would not mind owning long term. Just like any option strategy, the put can be rolled or managed if it moves against you, if you get closer to expiration, or it can be used to obtain stock to maybe convert to a covered call. We discussed that a little bit last week with our discussion on the wheel strategy. Now, to the direct question, what is the percent naked yield in reference to a naked call or a naked put position? Well, that is the rate of the return of the premium against the full capital you might need to purchase the shares of stock. So we base it on the full cash secured investment. Some of you may be using margin on your naked puts. That's perfectly fine. Some of you might be trading calendar puts or bull put credit spreads as well. And so that might be a way that you don't have to have as much margin, but just selling the naked put by itself, the percent naked yield is based on the full cash secured amount. Here's an example this afternoon from American Express, AXP. The stock was trading around 112.57. We could sell a 1 month out December 105 strike, so about $7.50 below the current stock price, or $7.50 out of the money, for 151. The broker may require the full stock obligation depending on your account. So if I sold one contract, I'm going to take in $105, but I may have to put up $10,500 for the next 28 days through December expiration to cover the obligation of this naked put position. The percent naked yield is simply the option premium we collect divided by the strike price, or the margin requirement. So we'd have $1.51 in premium divided by 105 strike, which we see here on the right as well would be 1.5% if the put expires worthless. We had to keep that $10,500 on hold during the time of the trade. So it's essentially like buying a stock at 105, holding it, but we got a 151, so we make a 1.5% return. Now, also important here, you see the break-even line on our profit and loss chart. That's right here in the sort of magenta line. Remind me to change the color we're using later there. That's a little brown color. I don't know if I necessarily like that one. Yeah, let's do that. Okay, anyway, in any case, so what is this percent to break even, which is also important? That's right here at 103.49. Well, I made an error. I'm sorry. I caught this on the first slide. I didn't catch it on the second slide. As you can see here, the break even is simply the strike price of the option we sold minus the premium. It'd be 105 in this case, not 150. So what does this mean? Well, if I'm put the stock, I'm put at 105. I'd have to buy shares of stock at 105, but I kept $1.51 in premium, so I'm not losing any money until the stock is below 103.49. right? At expiration, that's essentially my break even. Or last couple minutes before Friday's close, I could buy to close the put for 151 or close to it if it's trading at 103.49 and would be at break even. The percent to break even is how far the current stock price can fall before we hit the break even value. In this case, it's 8.1%. So the stock would have to fall about 9 points from 112.57 to 103.49 before we hit break even. So we have an 8.1% essential basic protection, in this case, to break even. A little bit lower, about 7% to our strike price of 105, 7.8% to the strike price, but 8.1% to break even. Okay, so that's the naked put. That's what the percent naked yield is. And the other important value there, the percent to break even, in relation to the naked put in the question. Now, what about this idea that was talked about in this discussion that we had on, that earlier discussion, earlier webinar we were talking about that Alberto was watching related to the basics of the naked put. Why would I say, or why was it stated in that webinar that a 1% return, 1 to 1.5% return is considered optimum? Here are the search results from our monthly picks of the day, naked put screen that Ernie created. And on the first page, there's about 36 total results that came up around 12 noon Eastern time, around 12:05 today. And all of these are double, triple, if not almost 5 times, 4 times more than that optimum level I discussed, or that was discussed in that older webinar, of 1 to 1.5%. Okay? Does this mean that that 1 to 1.5% is too conservative? Well, let's think about that for a moment. Let's go to Power Options now. And what we're going to do on Power Options is run the search again. We're going to take a look at some other ideas here and some other concepts as to why, even with a 30-day out, 28-day out option, standard monthly option, in that older webinar, we said that 1 to 1.5% might be the optimum return for a naked put position. Okay, so now let me pause the screen. Now let us switch screens. Let us go to Power Options, of course, and we are going to continue our discussion for Alberto on the naked put, percent naked yield, and the optimum return. All right, so we're looking at the basic trial account here at Power Options. For those of you just getting started, I'm going to encourage you to take advantage of the 4 steps here: the free quick start guide, flash tutorials, the various archives of free webinars, of course, and live webinars as well, and the free coaching sessions also that trial members and subscribers can take advantage of as well. All right, now let's go to naked put. So I'm just going to click on the strategy, and we're going to go right into the search. I'm not going to go into the simple picks of the day view. We're going to go directly in the search and pull up the full list that we saw. Oh, it's even higher now. But the full list we saw roughly from 12:05. We've got FUTU holdings at 48.55. And the 45 strike put, 28 days out, has a yield of 6.4%. That's 4 times, more than 4 times that 1.5% we had mentioned. This is a decent range out of the money, but it does have a lower probability of 62%. And here's one at 69%. In general, most investors we talk to who are looking for a naked put will still go 70 to 75% probability, hoping that the put expires worthless and they'll keep the premium. If they do get put, they're okay. And sometimes it's okay to sell the at-the-money put if your end goal is to really get into that stock soon, but you just want a little extra premium at this time. But many people will go out of the money a little bit, of course, to have a good probability of the put expiring worthless on a stock they wouldn't mind owning long-term. What's a type of stock you would consider owning long-term? Well, I might look for something that pays a dividend. I might look for something, of course, that has a good earnings per share. The growth has shown good management and good earnings performance. And I may be looking for large cap stocks, or at least mid to large cap stocks as well. So let's change some basic things here. I'm going to leave this 6% out of the money. We're going to go, let's say, with just that 75% probability or higher, theoretical probability. The stock will stay above our short put strike price at expiration, and we will keep the premium. Jumping ahead here to Roger's question, how is probability determined? Well, it's essentially taking a look at the past 52-week trading range of the stock, Roger. We apply one standard deviation to those values, which allows us to get a bell curve. Based on that bell curve, we can say on the past performance of the stock, what is the likelihood that it would be trading at or above a specific strike price or at or below a specific strike price, Roger, within the next 28 days, 10 days, 5 days, and so forth as well. What the probability doesn't take into account really, Roger, I mean, we have some areas in our equation to apply current implied volatility, of course, but what it doesn't take into account is if your stock has earnings coming up in the next few days between now and expiration, just you might as well throw the probabilities out the window, okay? Because it's based on the past trading range, which may include other earnings, but you never know what's going to necessarily happen at your coming earnings event that's between now and expiration. All right, so that's how the probability is determined. It's similar to a calculation with delta. Some of the same factors are used in the equation for delta as they are for probability. Quick example, that's not a good example. None of these are really great examples, but here's one. The probability above on the national beverage position for December. Stocks at 93.59. The December 85 put fair range out of the money has a delta of 0.25 and a probability 72.6%. So let's say it's close to a 75% probability and a delta of 0.25, you know, kind of reversed in that sense because we're looking for the probability above, not the probability below. But there's an idea, Roger, of how they're kind of similar, but still different. The probability is a little bit different equation, of course, than the delta. Those similar factors are used to calculate both. Now what am I going to do? I changed my probability. I'm going to leave everything else. I'm going to go to the fundamentals. I'm going to look for a stock that pays a dividend of at least 2%. Remember, general outcome of this strategy is that I may end up owning shares of stock. So something that's going to be a core holding in my account, maybe I want to look for a dividend paying stock. And I had mentioned mid to large cap. Well, I can take a look here and say that, okay, here in PowerOptions, we measure this by millions. So if I'm looking for a mid to large cap stock, I want to put in a filter there of greater than 2,000 in that case. So that'll find all my mid and large cap stocks. Hold on, folks. 1 second. Okay, there we go. Sorry about that. And last but not least, positive earnings per share growth. Okay, so I'm going to look for something greater than 5%. Now, in Ernie's list, he does have a specific stock list that's being selected, so we need to remove that. So I got to go to the lists, and we're going to go ahead and go to no lists as well. So what did I do? I changed the probability, put in some stock filters I might look for a stock that I wanted to own long-term in the naked put strategy. Yeah, I'm going to remove earnings between now and expiration as well. We added a little dividend. And I took out the list, of course, so we're looking across the entire universe of options. Let's go ahead and submit it. Okay, now this is pretty good. A reasonable list. And we see some here that are double what we are talking about. Alberto 2.2, Avnet at 2%, Lincoln Corp at 2%. And look at these volatilities though, 0.6753, 0.62, 0.55. In normal market conditions, which we know we're not in, we're coming out of some abnormal market conditions, and we still don't know what's normal going ahead right now. Let's be honest. We don't know how much volatility is going to spike. But in general, in normal market conditions, the average implied volatility across all options might be around 0.4 or 0.45. Might be a little bit lower. In general terms, you might be looking at around 0.2 or 0.3 as an average implied volatility, 0.35. Okay, well, let's lower the volatility. This is one we are going to change. We're going to put it down to 0.45 or less. Okay, so in normal market conditions, this is what we would normally expect for a growth stock, mid to large cap, good earnings per share growth that pays dividends with 0.3, 0.39, 0.36, 0.4 implied volatility. Where are we? 1.7, 1.6, 1.5. Prudential, General Motors, AIG, Dow Chemical at 1.6. On the next page, we're going to see positions such as AbbVie, Johnson & Johnson, but they're going to be slightly lower in that case, aren't they? They're going to be along the lines of a 1.0, Crane Group, Citigroup, 1.4. Okay, that's kind of in the wheelhouse. Blackstone, Eli Lilly, 1 month out, 75% probability or higher. Okay, the 135 strike, 132 is a 1.1% return. Sure, you could sell the 140 and you'd get a higher return, but you're just going closer to at the money. You have a lower probability. That's going to help you with what gauge you're setting up for. So in that older webinar, we were talking about quality stocks that paid a dividend, a good 70 to 75% probability, and a good 5, 6, 7, 8% range out of the money for a 1 month trade. This is what you would expect to see. Okay, this is the expectation you have. Travelers Group, restaurant brands, Federal Trust, PNC, 1.3, Citigroup, 1.4. So you see these big names here, but even 1 month out, relative good range out of the money, Alberto, we're only looking at about 1.5% in that range, okay? The first ones that did come up earlier, there they are, they're at the very bottom. AbbVie, 0.5%, the 92.5 strike. Sure, I can get a better premium for the 95, but is that the range out of the money I want? And does it have the probability I want as well? This Johnson & Johnson one, 135. Okay, if there's a 137.5, that might be interesting, but it would have come up in the search results. But the 135 is only a 0.4% naked yield. Okay, probably wouldn't do that. I'm looking for a minimum of 1%. But again, what is the potential outcome of a naked put trade? The potential outcome is that you may end up owning shares of stock. You want to make sure that the criteria that you're using reflect a stock that you would potentially not mind owning long-term in your account or converting to a covered call position if you are put the stock. I don't know Futu Holdings. It's got an enriched premium because the implied volatility is at 0.859. This could be a very, very profitable trade. But if I do my research and the first step, I take a look at the stock chart, I only got a 3-month chart that comes up. This is phenomenal. But do I trust that this is something that I'd potentially want to hold long-term in my account if it's put to me? It's had a very strong bullish run. I got to do a little bit more research. What happens if it reverts back to halfway of this last run from 35 up to 50? What if it comes back down to 42? Am I comfortable with the stock at that price? Am I comfortable with my cost basis if I got put the stock with the strike price that I'm selling? Looking at the chart, looking at the technicals, looks like a good move for a naked put, perhaps. But something is coming up. Something has happened to this stock that's caused that implied volatility to be very high. Per our discussion last week, very briefly, we entered into a basic discussion of implied volatility being a double-edged sword. What do I mean by that? If I'm selling a cash-secured naked put, and let's just take big lots for a minute. Okay. And so here's our profit and loss chart. It's skewed, so we're focusing just 10% up and down, but let's increase this a little bit so we get our nice little hockey stick graph. There we go. Oh, shoot. Sorry about that. So we're selling the 45 put on big lots, $49.50 roughly, and we're getting $2.10 for it, $2.12 for this position. That's a 5% naked yield, provided the stock stays above 45. Great return, don't get me wrong. But something's going on with the stock, why the big lots put is so inflated that stocks near it. One that comes to mind is a stock that I trade as a Mary put right now called DAR, which is around a $46 range. And on DAR, the December 45 put is trading for less than half of this premium. We saw the implied volatility was around 0.85. 0.84. It's pretty high compared to what we would normally look for. This could be a very successful trade. This could be a very profitable position with the 5% naked yield. Almost 3 times of what we said is the optimum one as well. But this stock didn't come up in our criteria for the dividend. Even if they pay a dividend, it didn't come up with the positive earnings per share growth. It is a mid to large cap stock. We know that. I might even use a stock trend or MACD as well, which Futu, that first one's still to come up. But there's something about this one that didn't meet the criteria that I changed. What is it? Why is this so inflated? Oh, it's 0.75. I'm sorry, Big Lots. I was thinking of Digital Turbine. But the Big Lots is at 0.757. That's probably double what it normally is for implied volatility. And why is that? Well, because in the original screen, I didn't select to avoid stocks that have an earnings between now and expiration. And although it hasn't been confirmed yet, what we're looking at here is that in this case, this position, we're expecting earnings on December 4th. So I don't know what Big Lots has done with its earnings. I know it has a negative earnings per share growth. That's the other reason why I didn't come up on that new filters I used. Did it pay a dividend? I thought it did. Yeah. So it still has the dividend we would have matched, but it has a negative earnings per share growth and it has earnings coming up. That's why I wouldn't enter this specific trade. Implied volatility is a double-edged sword because that means that some high activity is going on with the stock or some speculation of some future event coming up is going on in the stock. It doesn't have to be earnings. It could be other things. And that could lead to wild swings in the position. And that's maybe not something you want to trade with a naked put position, with an iron condor, with a bull put credit spread, or a directional spread trade, because you could find yourself in a large loss. The stock suddenly falls significant value as well. So in that older webinar, that's what we meant, Alberto, per the discussion of the optimal range is around 1 to 1.5%, because normally these slow progressive stocks that do pay a dividend and have the good quality stock criteria that we would potentially look for to own a stock long-term in our portfolios typically have a volatility, implied volatility of around 0.2, 0.25, 0.3, 0.35. And just based on the calculations and the expectations and the pricing models and what's actually shown in the market is that in general, going for the probability we want, going for the range out of the money we want, going for those basic stock criteria that we want as well, what we typically see are, sorry about that, I want to go to none, are just returns around 1.5%. There's some outliers here. Brinker, Synovus Financial, and Cimarex Energy. They might be fairly good trades. Do your research and analysis, see if there are positions that you want to get into. But you can see that those top four, those top three, have a high implied volatility, higher than the averages around 0.42, 0.41. We go into the next pages, and then lower return would be at 0.39, 0.35. That's what we mean by the double-edged sword of implied volatility. A higher implied volatility leads you to great premiums, looks like a trade that's almost 5 times, 4 times what you'd expect on average, and it looks like a no-brainer to take it. But that means something is going on, or there's some speculation of some event or some report coming up on the stock may cause it to fluctuate wildly. So a directional trade such as a covered call, naked put, bull put credit spread might result in larger losses than you wanted due to the outcome of that future event as well. So that just backs up why we say between 1 to 1.5% in the normal implied volatility range of a good quality stock. Okay, so that was our 30 minutes. Actually, it was much less than that. It was about 22 minutes after our introduction for Alberto regarding the naked puts and, of course, why that 1 to 1.5% was shown as the optimal. It's related to what we commonly see in those positions with an average implied volatility as well. Okay, so now, follow up from Alberto right there. I thought I was done. I didn't see your question come in as my question pod sort of shifted on me. Alberto says, got it. Does it make sense looking at implied volatility without comparing it to historical volatility? Should have stayed on the search screen there. And let me see if I can just go back. There we go. And what Alberto is referring to is one of the filters here, IV over HV. It's a way to determine if the option is considered one of the two ways in power options, that the option is to be considered overvalued compared to its underlying stock performance. What do I mean by that? The HV there is the historical volatility, the volatility of the stock, the frequency of how the stock moves up and down, of course. And we take the IV, the actual implied volatility of our option, divided by the historical volatility. And a ratio greater than 1 tells us the implied volatility is greater than the historical volatility, which means the option might be overvalued. Okay? So we took some out of that equation. amazingly enough, wasn't it, that first one that was there, the Cimarex Energy, and I think the second one that was on our list too that I just forgot, that Synovus one, they don't. The stock fluctuates more than the current implied volatility range does. I mean, the implied volatility is higher than the historical volatility. It was lower for those other two. It would be considered an undervalued option. It's not a bad idea to look for options that are considered overvalued in this case. We still have some good ones there: Pepsi, Travelers, Blackstone, General Motors, Dow Chemical. Good quality, long-term holding type stocks in that case. I do have several power options investors that do trade covered calls and naked puts and look for higher implied volatility and take that risk and have stronger stomachs than I do. Just for me personally, when I sell a naked put, it's because I want to go into, I apologize, I want to go into the stock potentially with lower strike, and then I'll convert it to maybe a collar, a covered call, or a married put for a long-term play. So now Fernando asked a question related to this. We're going to keep it going on this naked put discussion. And he says, can you make a sell put simulation on radioactivetrading.com? And what he's talking about is on radioactivetrading.com. This is just the open position I had on craft today that I had to adjust. We might take a portfolio look at that later on. But on radioactivetrading.com in the resources section, we have what's called this trade simulator tool. Okay. And the trade simulator tool helps you run a scenario of what you can expect potentially the outcome of your trading plan to be. In other words, if I'm just buying straight stock and I'm going to put a target price of 10% gain, that's going to be my close. I'm going to close the position if it's a 10% gain. I'm going to stop it if it drops 10%. I expect maybe a 50% win-loss ratio. Half the time I'm going to be right, make 10%. Half the time I'm going to be wrong. I start off with $10,000 and I flip a coin. Okay? I flip a coin 100 times. Heads I win, tails I lose. Will I make money? Okay, so we flipped the coin and this simulation gave us 57 wins. Hey, we took $10,000 up to $17,779. 77% return, 57% win ratio, of course. When we don't get the win ratio, we lose 65%. All right, so that's what this tool is doing. At 54%, hey, we're up 30%. That's great. Trying to get close to a 50-50. It's random, but every now and then, okay, 52 to 48, you make 7%. Because you start out with 10,000, ending amount through various strings of winners and losers, may end up with a 7% return, being right 52% of the time. And then what we can do is put in other numbers. And you see here, Fernando, we already have the defaults of what you might look for a covered call. Let's take that higher end. Enter a covered call, Fernando, which is a parity trade essentially to the naked put. Has the exact same risk-reward profile, especially if I'm going fully cash secured. So let's say we did go for that maximum, a 5% return. And instead of a 70% probability, instead of the 75 or 78% probability I was looking for further out of the money, Fernando, we're looking at 70%. And if the stock falls 10%, I may look to close the position. Or let's change that. Let's say if we have a 7% now, let's say if we have a 7% loss, we're going to change it. What do I mean by that? The stock falls 10%, we decide to get out of it, but hey, we kept our 2, 3, or 4% premium, so on average, we take a 7% loss, even if the stock fell 10%. And of course, we're starting 4 or 5% out of the money as well. Okay, so this might be a really good one, and I'm not going to go 70%. We're going to go 50% as well. So I start off with $10,000, and I put $5,000 into one naked put and $5,000 into another. 2 trades each cycle, flip the coin. Okay, so 71% success rate. Hey, we've doubled our money in this case with a 5% return. 69%, okay, we're still good. 67, I'm just trying to see if there's one lower. 79, fantastic. Okay, 65% winners, 40% return over 100 trades. But what are you going to look for? In general, especially if everything starts to settle down, which we're not expecting right away, but over time, the next 3 to 4 months, the market settles down, volatility comes a little bit lower. Maybe we start seeing distribution of these vaccines globally to help what we're in, and maybe other things happen and things get back to normal. Are we seeing 5% yields, Fernando, on good quality stocks with a 70-75% probability? No. With a 70% probability, we're still at 3 or 4. Okay? And in that case, let's go back to this range as well. We're going to go back to 2. We're going to go to 2.5. Okay? And we're going to put that there, and we're going to put a success rate at 75%. I'm sorry, probability of loss. I did that wrong. 25. Okay? All right. Wow. 71% win ratio. Losing money. Okay? Cutting down the return to look for stocks with lower volatility might give you a better positive success rate as well. But you need to be right that 75% of the time to profit. 74% still at a loss. 75, small gain. 79, 26% return. Okay? And Fernando mentions, well, but loss limit is more than 7%. You have not protection. Well, what I'm factoring in here, remember, on the naked put, okay, naked put position, here's the stock price. We're starting off 7% out of the money. I am being nice, Fernando, in that case, remember? So this is maybe 6% out of the money. And here, another 7% drop might be a 7% loss. So in the case that the stock falls 13%, I'd see that 7% loss, which is possible and which does happen because I don't have any other protection on the downside. A 10% loss would be a 3% or 4% because I already started 6% of the money. So the stock can fall 6% before I need to start losing money or maybe even hit the break even, Fernando. It's kind of like the out of the money range we were talking about in the percent to break even. Okay, so we're starting a certain range out of the money. So the stock can fall a few percentage points before we start getting in trouble. Here's probably our break even. So that might be a 6.5 or 7.5% range. So even if the stock falls 10%, which can happen, we're down 3.5. But we can see stocks that fall 15%, 20% in a 5, 6, 7 day period. So average out the losers 7%. Okay, with making 2.5% on a quality stock, being right 75% of the time, you see you almost need to be right 80% of the time to hit the targets that you want. In reality, I think Fernando's question was more related to this other factor. Because if I got a 5% return, as we saw with Futu and one of those other trades on the naked put search, I've got a pretty good range to break even. But on average, if I'm getting a 5% return, I'm probably closer to the money, which means that we're going back to that 70% probability, probably even a 65% probability only instead of 75 or 80. And if the stock falls 13, 14%, yeah, I'm going to keep my 5% yield, but I was closer to the stock to begin with. So we might actually be at an 8, 9, or even a 10% loss. Let's just put it at 9. Okay, on average when we lose. So 73%, hey, we're still getting a good premium and a good profit here. The 67% winners were still, sorry about that. Hate those things. In that case, we're still looking at a good return there as well. But if the losses start to increase quickly, now you're at a loss. So that's 66. 69, you're at a loss. We're showing a win. That's why controlling losses is so important, which was kind of Fernando's point in that case. Because unless you're picking stocks that don't move that frequently, if you're trading the naked puts for the premium alone and looking for a higher implied volatility, you're going to be more in a structure that might be looking somewhere along the lines of 5% return, a 15% loss. You still might be right 65, 75% of the time. But is that meeting your goals? That's a 0.5% return on investment. You're not controlling the risk, and you can put your stop orders in, but as we all know, stop orders are assumed insurance. There's no guarantee. When is the stock going to fall 10, 12, 15% or have a big move? You know exactly when it's going to happen in the pre or after market hours when you can't control it. When that falls through, all your stop order is a market order saying, close me out of the position if it's ever below this price. I sell that Futu 45 put, and I set a 5% stop loss below that put strike price, around $250, so at $43. Futu gaps down from some bad news and opens at $35. Guess what? He can't close the put for me at what price it was at the $42.50 I put in. I get closed whatever that put is trading at. Got a couple $2 or $3 in for that 45 strike put with that high implied volatility. Stock's at 35, cost me $10 to buy it back. that's a significant loss on the position. Okay, it's more than triple, 3 times the premium you collected. So in that case, it can really come back to haunt you as well. All right, so that was the simulation we were talking about there with no protection to the downside, Fernando. In that case, what you can expect. And at any time, of course, I'm sorry, I should go back there. Just go to the radioactive trading, click on radioactivetrading.com, click on resources, and go to the trade simulator tool. And you see we have defaults there for what the married put would look like, a credit spread might look like, and you can plug in your own numbers. What is your trading plan? Put in your target, return, the loss limit you're trying to control to with stops or other things potentially, your win percentage that you think you're going to achieve. You know, out of the money spreads, I might be doing, I apologize, out of the money spreads, I might be doing an 80 to 85% probability or higher, looking for my target, okay, making it 83. So I'll set that probability of loss. It's reversed. So an 85% probability would be a 15% probability of loss naturally. And then your starting amount and how much you'd invest to each position. And you can see how that performs over time as well. Okay, so it's a great idea just to gauge, is your trading plan meeting your goals? What little tweaks could you make to improve your trading goals as well? That was the subtle follow-up there, another 10, 12 minutes into that as well. So we covered the naked puts, we covered the percent naked yield, we covered the reason why we talk about a 1 to 1.5 is an optimum. We discussed the other ideas that might come back to haunt you related to, is higher implied volatility a better way to trade naked puts? Or is it more important, in our opinion, to focus on stocks you'd want to own long-term and core holdings in your account? And then we ran some brief simulations to see what we might expect from a naked put position. It's a good strategy to use in your portfolio, I feel, for stocks that you want to own long-term, not just the ones with the highest premium that might be fly-by-night and a little bit risky.